everyone. It's my pleasure to welcome you all to this edition of CRISIL TV, where I will be taking you through CRISIL's perspectives on the NBFC sector. Very recently, we had organized a day-long seminar on the NBFC sector, where CRISIL had shared our perspectives on what we think the sector is going to evolve into going forward and the performance of the sector on various parameters. And this was attended by the who's who of the NBFC sector. What I will do today is share with you some of the key summarized findings that we had shared with the audience at large in that particular seminar. To start off with, I believe that the NBFC sector has in recent times been the darling of the capital markets, whether it be the equity investors who have taken share prices to all-time highs in recent times and resulting in market capitalization going up substantially. On the other hand, we've also seen debt market or bond market investors taking a fancy to the instruments issued by the NBFC sector. So that has increased access for the NBFC sector to the bond markets. Now, is all this an irrational exuberance, or is it backed by sound underlying fundamentals? So our entire assessment or analysis looked into analyzing the fundamentals of the NBFCs themselves and how it impacts their credit profile. To start parametrically, if you look at the business growth of NBFCs, that has been going up phenomenally over the last 5 to 6 years. If we go back 4 years, NBFCs constituted 13% of the overall credit pie of the Indian financial sector. That has now moved up to around 16%. We expect this growth to continue, and NBFCs will hit a level of 19% by 2020. Now, which are the segments which are driving this growth of NBFCs? Now, there are 3 key segments which are showing the maximum growth. 1, housing finance. 2, we are looking at the vehicle finance segment. And number 3 is the wholesale credit. These are the 3 segments which are driving the NBFC credit growth. Now, of these 3, the fastest growth is coming in from the wholesale credit segment, albeit on a smaller base. So if we look at 4 years back, where this segment constituted only 7% of the NBFC outstandings, today it is around 12%, and we expect this to go up continuously. Now, if we look at what is driving this wholesale credit growth, it is essentially 2 parts. One is real estate and structured credit, which post the implementation of RERA is expected to pick up due to greater transparency in the sector, in addition to, of course, needs from real estate developers for funding. And also, we are seeing a lot of demand coming in from mid-market promoters. So that's where structured credit is going up. In addition, we are seeing increased government spending on the infrastructure sector, chiefly roads. That will also increase demand from the infrastructure space for wholesale financing NBFCs. So, of course, the other 2 segments grow because of underlying fundamental demand. So, the housing finance sector, driven by affordable housing demand, will grow, and vehicle finance will grow because of, again, increasing movement to higher tonnage vehicles, higher value vehicles, and again greater spending on the infrastructure space, which will also help vehicle finance growth. Another segment which we see having good growth potential is unsecured loans to the SME segment. Now, there the growth will continue to be high, but the base is quite small, so it will not be a driver of the overall NBFC growth per se. Now, moving on to the second broad area of analysis is asset quality. Now, asset quality for NBFC sectors has been reasonably stable over time, whether it be housing finance, wholesale credit, or even retail finance. Retail finance, in terms of reported NPAs, has shown an increase over the last 3 years, but it is largely driven by increasing stringency of recognition of NPAs by the regulator and not due to any underlying fundamental deterioration in asset quality. Fundamental asset quality actually has been improving when we measure it by a parameter called delinquencies on a 90 days past due basis. Now, on the resources profile of NBFCs, that has been improving over time because, as I mentioned a little while earlier, they are having increasing access to the capital market investors for raising funds through bonds and commercial paper. So the proportion of bonds and commercial paper in the liability profile of NBFCs has increased over time at the expense of bank borrowings. Now, this has in turn lowered their overall cost of funds because bonds and CPs are a cheaper cost of borrowings. Now, because that has happened, it has helped the profitability profile of NBFCs in spite of high pressure or competitive intensity from the private banks, which has forced their yields to come down. So, but because they have reduced their cost of borrowings, they have been able to maintain their profitability. In addition to that, on the capitalization side, NBFC's capital profile continues to be comfortable because gearing levels have come down and they have greater flexibility of raising fresh capital, not only from promoters and market, but also from private equity players. So what we see is both the business and the financial profile of non-banks have been steadily improving over time, and they are today in a kind of a sweet spot. So perhaps they are in the best phase of their evolution so far. So is everything hunky-dory? Not really. So we need to be cognizant of the risks that are there in the segment as well. So in terms of risks, in an area of fast growth, there will always be pockets of risk. For instance, if we look at wholesale credit, which is growing fast, because of the chunkiness of the assets and the concentration risks therein, there could be liquidity level stresses if the overall stress in the economy goes up. At the same time, on the unsecured loans piece, loss given default could be high because there is a lack of collateral. So it is very important that these kind of risks are appropriately recognized, assessed, managed, and more importantly, priced into the yields at which the loans are being provided. Having said that, as I said before, NBFCs are in a reasonably good shape so far, and we believe that given their fundamental strengths, they are well poised to continue their growth story going forward. And in addition to the normal business that they do, we believe that they will play a key role in furthering financial inclusion in India and ensuring financial services reach the nook and corner of the country. And that will be an important role that NBFCs will play going forward, in addition to also serving the underserved. So that was from my side a quick overview of the NBFC sector analysis we have done and shared with you some of the key drivers and the risks that are there in the sector. Hope you found that useful, and till the time we meet again, have a great time ahead. Thank you.